How is everybody doing? Welcome back to another episode of The Banker Next Door. I am your host, Dr. Joe Berquist. Today, I wanted to talk about an article that basically lays out three potential solutions for how can banks and even credit unions better compete against basically the behemoths in the industry. So let's jump into the article here real quick. So this is called Three Ways Smaller Banks Are Leveling the Playing Field. So while larger banks often have a leg up, smaller community financial institutions can take steps to remain competitive. This article is written by Cetin Duransoy, and this is found in Bank Director. And he starts out by saying, in 2023, failures of large financial institutions shook consumer confidence in banking. In fact, in May of 2023, poll from the Associated Press Newark Center for Public Affairs Research found that only a tenth of adults in the U.S. had high confidence in the nation's banks and other financial institutions, less than half the amount that reported high confidence in 2020. Despite this, big banks manage more than 70% of consolidated assets among FDIC-insured banks, up from 42% in 2003. Meanwhile, the number of community banks in the U.S. shrank by nearly 50% in the same period. From supporting small businesses to reaching communities that may have more limited access to banking services, small banks and credit unions play a vital role for the communities they serve. Yes, they do. How do these smaller institutions effectively meet consumer demand, attain sustained growth on a playing field built for a handful of behemoths? Here are three ways the community banks and credit unions are differentiating themselves and finding fintech solutions to solve their unique challenges. So, number one, highlight their impact to build consumer confidence. So with a smaller footprint, it can be easier for community banks and credit unions to have outsized impacts on their local areas. And then I'm going to go through all three here, and then I'll come back. So number two, solutions to combat high compliance and cybersecurity costs. So growing costs from compliance and cybersecurity protection can also disproportionately impact small banks and credit unions. Yes, absolutely. And then number three, agility and pricing. So despite a historic series of rate increases by the Federal Reserve, larger financial institutions continue to offer as little as 0.01% annual percentage yield on savings accounts. This has given smaller banks and credit unions the opportunity to offer American savers a much needed lifeline. So, okay, so now that's three. Now let's go back up to number one for a second. He gives us a couple examples here. One such institution is Ponce Bank, a certified community development financial institution founded in the Bronx, New York. Its founders countered the attitude that theirs was a community in decline, and in the decades since, Ponce Bank has remained focused on bringing banking services to areas where the help is in highest demand. Beyond community development, mission-led banking in the form of financial donations, employee volunteer hours, and other programs also gives smaller institutions an ability to set themselves apart. Yes, I would absolutely agree with this. But I think, I would also say community banks have been doing these kind of things for years and years and years. Community banks are typically very active in their local communities. They're in the local Rotary clubs, the BNIs. What else am I thinking of? They're in the chambers of commerce. They're dealing with a whole assortment of nonprofits. And like you said, they give monies to charities. They give monies to notable causes. They give monies to the Little League. So I think community banks do a tremendous amount in their local communities, and it's all about relationships. At the end of the day, community banking is a relationship business. You're building relationships with people in the communities to help drive the business of the bank, and you create that trust with the customer base. It's all about creating and maintaining that trust with the customer base. And I think community banks definitely do a better job than that than your big mega banks, your Bank of Americas, your Wells Fargos. And then it says, again, getting back to number two here for a second. So solutions to combat higher compliance and cybersecurity costs. So, finding solutions that help smaller institutions source deposits without adding to these costs can help them to grow sustainably. Those looking to compete with the economies of scale enjoyed by systematically important financial institutions, in other words, big banks, have looked to financial technology solutions. These fintechs can help them increase funding without incurring the higher cost of servicing, compliance, and cybersecurity. By using a full service funding model, dozens of banks and credit unions like Ponce Bank and the First Financial Northwest Bank have been able to secure retail deposits while relying on a fintech partner to market their products directly, as well as handling compliance and cybersecurity. Now, what is the problem with this? If you guys just watch the episode that I just put up on basically the FDIC's proposal on brokered deposits, you will see that this is now, that's easier said than done, that this has become a big issue. So, the fintechs can help with, increase funding without incurring the higher cost of servicing, compliance, and cybersecurity. They can, but now if regulators now want these fintechs to be more highly regulated and they want to reclassify the deposit as broker deposits, all of a sudden that kind of takes away from this game plan. This game plan that all of a sudden that's not as appealing and it may not be as easy to execute. So I think banks are still going to have some challenges and still going to have some work to do in this area in terms of compliance and cybersecurity costs. And now let's look at the last one for a second: agility in pricing. So, again, he talked about that how a lot of the bigger banks are basically paying nothing in terms of savings accounts, and this gives the smaller banks and credit unions the opportunity, Americans, to a much needed lifeline. Yes, it does, but it also means that, in other words, if you have to pay up for deposits, that is increasing what's called your cost of funding. So your cost of funding is going up. Okay, whereas the big behemoth guys, they're keeping their deposits at almost nothing. So their cost of funding is now way lower than the smaller banks. So yeah, it can give you an advantage, but it also hurts it also is going to hurt your profitability. You're going to get net interest rate, you're going to get margin compression there, which is what's happening to a lot of banks around the country right now. So again, there's nothing wrong with these solutions in general. But like I said, but I think number one, again, community banking, credit unions. I mean, these it's a community-based model. It's a relationship-based model, and they've been doing this for a long time. And I would point out that multiple Fed surveys have shown that community banks are held, in other words, customers are far more satisfied with community banks than the bigger banks in the industry. And that has held for a long time. And community banks are still, for small businesses, the number one preferred lending source, over the big banks, over fintechs, online lenders, whatever the case may be. Community banks are still the go-to place, and there's good reason for that, because they do a great job with the local banking and the things and relationship development. And like I said, number two, I think that's still going to be a very challenging area. Compliance and cybersecurity costs. We could see, like I said, with different administration, you might see some relief in the compliance area, but cybersecurity costs are just going to continue to go up. They're not going to get cheaper anytime soon. And in terms of pricing, like I said, you can adjust your pricing on deposits and stuff to bring in more deposits. Everybody can do that, but you just have to understand the price that you're going to pay. I mean, you still have to manage that, because I think there's some rationale to be like, you don't want to be the highest, game in town. I would probably try to keep my pricing, maybe you could keep it in the middle, maybe you can't, but that's certainly what I would shoot for. I would, you don't want to be the lowest person, but you don't want to be the highest person either. So anyway, but I thought, like I said, I thought this was a good article. I just wanted to share it with everybody. I thought these it was a, very interesting take on a lot of things. I got to, like I said, I thought it was a good way to kind of point out what is, currently being done, what the current situation is with some of these things, and how some of these things can play out over time. So that's it. So if you guys like this episode, please make sure to like, share, and subscribe, as that always helps the channel. Please make sure to leave your comments down below. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please make sure to check out thebankernextdoor.com and please check out some of the other content on the channel. I've done a lot of great episodes on a lot of great banking and finance and economic related topics. And I will see everybody again real soon. Thanks a lot.